Does age matter? We get this question quite a bit, or we hear, hey, am I too old for a policy? Man, I wish I would have done this so long ago when I was 20 or 30, but it wasn't shown to me in the same manner, or I just didn't like it, or I didn't have the money at the time. So, to the question, does age matter? Well, you see two things on the board here. One, you see price quoting, and then you see cash value planning. Here's the thing. If we are price quoting, meaning I'm buying a life insurance policy at the age of 30 or at the age of 60, well then yes, it matters. If I am focused on a death benefit, the older I get, the closer I get to death, to mortality, the more expensive that life insurance policy will become. However, when it comes to cash value planning, no. Then I put in there not as much. The reason why is as I grow older, you will see internally the insurance expenses are a bit higher. But without getting too deep into the weeds, when we set up a policy, if you've watched any of our content on policy design, if I'm 30 years old or if I'm 65 years old, could be older, younger, but regardless of age, if I'm going to put $1 into a policy, just to illustrate for simplicity, where can that dollar go? At the end of the day, it can go toward my insurance premium or can go toward my PUA rider. Think of it this way, initial insurance expense, cash dumping. If I put the same percentage, let's say I put 10% into the premium and 90% into the PUA, and I'm 20 years old, 30 years old, 40, 50, 60, 70, whatever age, if the ratios are the same, what you will find is that the cash values will be very similar. So putting in the exact same cash flow, same cash values or very similar cash values, but the older I am, that dollar will get me less death benefit. So, no, that could be a little bit confusing. Let's demonstrate. So what we've got here is just a quick spreadsheet, simple math, short funding period, $50,000 going in for 5 years. We can fund it shorter or longer, but what we're going to focus on here is same cash flow going in, same policy design, meaning of that 50,000, we've got the minimum insurance premium, maximum PUA or cash value allocation. You'll see oddball death benefits, and the reason why is the death benefit has a direct relationship to that MEC, that MEC, that's the taxable line on the policy. To simplify, we minimize the insurance expense to maximize the cash value. What's interesting about this is we pay in $50K the first year, the ratios are the same. What difference do you notice in cash? How about with the 30 and the 45-year-old male? About 50 bucks. For the 65-year-old male, it's a little bit less. Instead of 43.9, we're at 42.3. A little bit less in cash value. The internal expenses are a bit higher here with the term rider and such, but still, with that said, we have highlighted in yellow our break-even point. Our break-even point for these examples on each of the policies is when? Year 4. I've paid in $200,000. I have $200,000 or more. The 65-year-old has 199 and change, so we just rounded for simplicity. Point being, we're breaking even at the same period of time. Because we're older, it's not drastically delaying that break-even period. I've heard from individuals over the years of working with them that they've been exposed or presented whole life insurance in the past at the age of 30, and they didn't move forward because it took them 12 years to break even or get their money back. They said, listen, I can do better things with my money in the meantime. And I get it. I do the same thing. Then we see someone much older, 65, and we've done this with people who are 75, crossing over between 4 and 5, years 4 and 5. Now, as time goes on, you will find the younger we start, the better. If I look at the year 15 mark for each of the policies, the guy that started at age 30 has $438,000, age 45, 434, not a big difference there. And then at age 65, when I started, so 15 years down the road, I'm just about 80, about 388. So a little bit of a difference there. And that's because I'm getting near mortality, meaning the insurance company's mortality tables expect me to die around that neighborhood of 85 to 90. I start to see my cash value growth typically slow down as a result there. Point being, still a very attractive cash value policy for someone in their 60s that might normally think, hey, I'm too old, I can't get involved because I should have started 20 years ago. However, I mean, with that said, if we fund the policy properly, age does not matter quite as much. We can reap the same benefits. And in the early years, when I'm going to be using the money, if I'm starting at 65, doesn't really matter. I have very comparable cash value. So, main question or beginning question, does age matter? Kind of, as time passes, but my personal opinion is not really, as long as the policy is designed correctly. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.